Hi everyone, Tom Hayes here with Hedge Fund tips for our weekly video cast ending the week of November 15th. First off, I would just like to thank Ellie, Jerry, and Liz over at Fox Business for having me on the Clayman Countdown today. That was a lot of fun on the New York Stock Exchange. And that's going to be the first subject that we cover this week. I was asked about Warren Buffett's new holdings, his adds, his subtractions, and we had time to cover a few of them. But the first one was Occidental Petroleum, which is appropriate, and you can see the chart up here. It's pretty accurate because it was just a few hours ago. He added 7.5 million shares to his investment in Occidental Petroleum in his most recent filing. And what's interesting about that is Warren Buffett has historically stayed away from commodity stocks. And I put out a note in the last month actually about the exploration and production sector, laying out that we are now trading. The exploration and production sector was trading at the time of the note down to great financial crisis levels in 2009. And when I looked through the top 30 weights of the exploration and production sector that had comps in 2009, what I learned was that the earnings power of those 30 stocks had gone up over that period by about 32.4%, I think is the exact number. And yet the price was the same. Actually, we were trading slightly below the 2009 great financial crisis levels. So you were getting zero credit for, albeit anemic, earnings growth over that period. But zero credit for the earnings growth, number one. And number two, for 2020, the sector that's anticipated to have the highest earnings growth in 2020 is the energy sector, coming in at about 25% expected earnings growth, albeit off of low comps for 2019. So the laggards of today can be the leaders of tomorrow. And I think what's interesting about this additional $300 million of stock that Warren Buffett bought is it shows a real vote of confidence after putting $10 billion in the preferred stock to do the Anadarko deal. And, he's getting an 8% coupon on that, but the deal is going to yield $3.5 billion in synergies for the company, which is far more than the $800 coupon payment that they have to pay on the preferred. And where Buffett will really make the fortune over time, and he said when he did the deal that it was a levered bet on energy over the long term and increasing demand, is that he can exercise to buy, he's got warrants to buy 80 million shares, or about 10% of the company, at $62.50. So, if you look over 5 years, the way these cycles tend to work, if Oxy's a double, he can make $4 or $5 billion on the warrants alone. And while in some sense, that seems like, well, he got such a sweet deal. Well, he did a similar sweet deal with Bank of America for $5 billion in 2011 when they needed to shore up their balance sheet, and the shareholders did just fine. Warren did very well, and so did all the other shareholders, and I believe that'll be the case in Occidental. The other thing that I like about this Occidental that they asked me to talk about is that we're seeing more and more billionaires come into the sector. And there was an article today that I posted with Sam Zell and Tom Barrack going in to buy distressed E&P assets. I've covered in previous articles about Jerry Jones, the owner of the Cowboys. He made a stake in the 80s buying out of favor exploration and production assets in the 80s. And he used that profit to buy the Dallas Cowboys when they were down and out in the early 90s and parlayed that into a $5-6 billion fortune. And he's back at it. So he did $1 billion bet on natural gas E&P this summer. He's out doing more. Sam Zell's now in the game. Tom Barrack's in the game. And these are traditionally, other than Jerry Jones, these are traditionally billionaires that are not in the energy patch, taking bets because they see the demand increasing. And candidly, it's where you go to find value, trading down at great financial crisis lows. The decline rates are steepening. The rig counts are coming down. It's still really, really hated, but I like the signal that this gives from Warren Buffett. He not only got the sweet deal on the preferred, but he's now adding. And the other thing that's really interesting about the preferred part of the reasons the stock is trading down is because everyone's afraid they're going to cut the dividend, which, by the way, would be the most bullish thing that ever happened to the stock, because once the event actually happens, we could take off again. But the stock, they won't cut the dividend. They're doing some asset sales to clean up the balance sheet. They'll keep the dividend going. But for anyone that's worried about Buffett getting 8% on his preferred, just buy the stock. The dividend yield right now is over, I think today it was 8.5% on the equity. So if you want that sweet deal with upside, by the way, you not only get the yield, but you also get the upside owning the equity. You could invest, at a better deal than Warren Buffett here with the yield and the initial upside, not upside from $62, but upside from $39.40. So that's something to keep in mind with his Occidental position. The second one was Wells Fargo. Why is he selling stock? He's selling stock because Wells Fargo keeps buying back stock, and Warren owns so much of it that he has to sell to stay under the regulatory 10% ownership stake. So that shouldn't be taken as a signal that he doesn't like Wells Fargo. It should be taken as a signal that he just has to stay under 10% and he wants to keep owning 10% of the company. The third one that I was going to be asked about was Restoration Hardware. And this is, it was up huge on, Warren Buffett bought Restoration Hardware, and everyone's tying it to Nebraska Furniture Mart. And I think maybe there's something there, but I think more likely that was one of his lieutenants that run smaller portfolios, Todd or Ted. And usually you can tell because the size is small. So Warren does the big elephants, and these guys do the smaller size positions for the time being. That deal was only $210 million in stock. And if you look at the stock performance, they filed buying the stock for last quarter. The stock's already up 100 and some odd percent off of the lows. So my guess is if you're buying to be with Warren on Restoration Hardware, there still may be gas, but chances are they're already up 70, 80%. They bought it when it was down low last quarter, is my assessment of the situation. But leaving that aside, it is a growth story. I looked into it today. They've basically tripled earnings in the past 3 years after they've done a huge restructuring, and it seems to be working. They're anticipating doubling sales in the U.S. in the next 4 to 5 years. They've only got 85 stores in the U.S. and 28 outlets. So they do have room for growth. There's no question about it. But my feeling and thoughts on this is one of the lieutenants running the small portfolio. This is not necessarily Warren, although it may be, but usually he would be in much bigger size if he was pulling the trigger on it. And lastly, trimming 750,000 shares of Apple on a 248 million share position. That's a rounding error. As far as Kraft Heinz, Coke, Kraft is an interesting story. Obviously, they had accounting issues and it was mismanaged, but I look at Kraft down here, and basically every restaurant I go into around the country, no matter where I am, I sit down at the table and there's a bottle of Heinz, and all I can tell you is you must have to work overtime 24/7 to screw up a business like that is that ubiquitous globally, to screw that up. So my bet on Kraft Heinz is it's a story still in progress, and my bet is that Warren actually makes out on this very well over time. And that's basically all I was asked to cover on those stocks. And we'll have the clip out on Monday. We were on the 3 to 4 o'clock show, so that's not available yet. So that's that from the different stocks I was asked to cover. Now we're going to do our weekly review and try to keep it a reasonable time here. The core article that we put out that summarizes most of our positions was the Little Nas X Old Town Road stock market and sentiment results. And the lyrics, it's the number one hit he did with Billy Ray Cyrus, and you can listen to it on YouTube if you want. But he says, I'm going to take my horse to the Old Town Road, and I'm going to ride till I can't no more. And the symbolism was, we've talked about since we put out an article on September 5th. You can look it up here under sentiment. You can see all of our past articles. But the we talked about the possibility of a melt up into year end. And in a melt up scenario like we had in 2016 Q4 and 2017 Q4, the short-term indicators can stay pinned overbought. There's no question the indicators are overbought, and in any normal situation, you'd get a pullback or a little correction before you could resume a higher uptrend. But when people are crowding in for year end and trying to catch their benchmarks, and those are the structural things that we've been pounding on for the last 8 weeks, sometimes they can stay pinned. It doesn't preclude us pulling back a little bit, but there's a lot of money that's chasing right now, and basically what we're talking about, ride till you can't no more, is the data. So in the short term, what happens in the next 3 days or the next week, maybe you get the pullback, maybe you don't. That's really not of core importance. What is of greater importance is the data, okay? And looking at the intermediate term, does it make sense to stay on the horse until the data changes and it makes sense to get off the horse and wait for the storm to pass? And right now, the data globally has been troughing. It's been coming up off of its bottoms in Europe. You saw PMIs, the earnings estimates. So let's go through the 7 conditions. If you want to cover the stuff that I talked about on pinning, where the short-term indicators can stay overbought and the market melt-ups, just click on this Katy Perry hot and cold stock market from last week. We go into a lot of instances where short-term indicators were overbought, but they stayed pinned due to those type of catch-up plays and institutional demand to catch their benchmarks. So the 7 conditions that we laid out in this week's article was, number 1, institutions and individuals got too bearish when the yield curve inverted in August, and they're now playing catch-up into year-end to meet their benchmarks. So Bank of America Merrill Lynch puts out a global fund manager survey once a month, and I think this is one of the most important pieces of data that comes out. And basically what's happened in the last 30 days is their cash levels have dropped from 5.2 down 5.25 down to 4.2, which is a huge drop. And the bearish view is, and you can click here if you want to get into granular detail. I'm just going to give you the summary. The bearish view is now everyone's in, it's time to go short. And that's a reasonable way to look at things. But when you look back at the last four out of the last 5 times that people panicked in and cash levels dropped so precipitously in 30 days, you were near the beginning of the rally, not the end of the rally. And I'm actually going to show you the chart here real quick, just so you can see, because it's counterintuitive. But when you have the cash levels drop down to 4.25 from, up here in the 5 plus, here, very much like this 2011-12 period, breaking out barely, and the cash levels drop, and you're really at the beginning of a rally. Here, you were at the beginning of the rally, not the end of the rally. Here, you were close to the beginning of the rally, not the end of the rally. Here, same thing. The only exception was 2002, when you were already in a material downtrend of lower highs and lower lows. So we are not in a downtrend. We just broke out. We're in an uptrend. And these cash levels dropping means people are panicking back into the market because they were moving into cash and bonds for most of August and September. So that's condition number 1. Number 2, the other thing about that survey, by the way, the last time fund managers got this bearish on the US dollar, it depreciated by 11.3% over the next 8 months. If history is any prologue, and obviously that's too small of a sample to make anything of it, but that would be an additional boon to 2020 S&P 500 earnings, which is just phenomenal. If we got a lower dollar by 10% over the next 4 to 6 months, what it would do to 2020 earnings would be fantastic. Second, the last 3 instances of the 210 yield curve inversion, if you remember, what drove people to bonds and cash in August was the fact that we inverted in the month of August, the 2s and 10s, which is the one that matters. After each of the last 3 inversions, as defined by these red lines, you got approximately a 30% rally. In most cases, it was mid-30s, but at least 30% rally from the point of inversion to the peak of the market. So the implication, having barely inverted in August, is that we've got at least a year and a half from that point, and probably, if history is any prologue, 30 some odd percent. And we've moved up a bit since inversion, so take that down by whatever we've moved up. But that just shows you where we are in terms of the cycle. Now, if this is more of a mid-cycle adjustment like 95, where you came very close to inverting, you could have what Powell called a mid-cycle adjustment. It's unfortunately we inverted, but maybe they pulled us out quickly enough. We'll just have to watch the data. But we could have a real second leg here as a possibility. But for certain, we should have another year and a half to a peak. But we'll keep an eye on this possibility. Third, the earnings are still strong. As of today, we're still hovering around $179 for the S&P. So call it 9.7, 9.8, virtually double-digit earnings growth for 2020. Same thing with the EU Euro Stock 600. You can look at the data here and here. And this will be the first time that we have earnings growth since 2016, both for Europe and for the US. And what's interesting about that is Q4 of 2016, after 2 years of flat growth and 3 quarters of negative earnings, which is exactly what we have now, 2 years of flat earnings and 3 quarters of negative earnings growth. We're coming in this quarter, I think, at negative 2.1 from negative 4.1 estimates, or somewhere. We've gained about 200 bips of improvement. At one point, they had it down to negative 4.8 after the quarter started, but that's recovered to negative 2.1. Long story short, it'll be the third negative quarter of earnings growth, which is the same scenario we had going into Q4 of 16. Q4 of 17 had 11% earnings growth. We're looking at, right around 10. And from Q4 16 to Q1 18, the stock market rallied about 30%, actually over 30%, which is in line with what it historically does after a yield curve inversion. So there are reasons to think that possibly good things can happen in the intermediate term, despite many people looking at short-term overbought signals. Third, we've covered this quite a bit, but it's increased. So the Fed has gone from tightening to easing. They cut 75 basis points, which we needed, and they've increased the Fed balance sheet in the last 11 weeks by $280 billion. So that is huge amounts of liquidity. People will say, well, that's on the short end. But look, the bottom line is they're giving cash for risk-free assets, and that cash can then go into further out on the risk curve. And you're seeing it. You can correlate it to the equity market. It's working. Furthermore, ECB's back in the market. They just started $20 billion a month in quantitative easing in the month of November, on November 1st. And BOJ never left the game, so now it's got help from the ECB and the Fed. And what I love about the ECB is every time I've seen Christine Lagarde on TV for the last 10 years, she's always bearish. So my guess is she's going to be pushing for stimulus from Germany. She's going to keep her foot to the pedal on growth, and that will be a very constructive outcome globally. Fifth, multiple expansion is likely. If you believe we are in the later part of the cycle, with the discount rate lowered by 75 basis points, the norm would be closer to a 19 to 21 times forward multiple. We're at 17 and a half times forward, and that's without the phase one deal signed yet. That's without a dollar depreciation if that comes to bear. And that's not without estimates potentially certainly firming, but maybe going up on the signature of a phase one deal and a de-escalation of tariffs. But that's, we'll see how that plays out. Sixth thing, the argument is that 10-year plus expansions are too long, but actually not having expansions that long is what's abnormal. So in this article we wrote in July, we look at those situations, the lost decades when the market consolidated sideways. And once it broke out, you had here from 1953 to 1968, a 15-year rally. Here you had the lost decade from 68 to 82. When it broke out, you had an 18-year rally to 2000. And here we had a lost decade from 2000 to 2013. We've only broken out in 2013. And so we've had a 6-year rally. So that doesn't preclude 1987 corrections in the interim. So you can have that, year and a half out if there's a mild recession. But on balance, those secular bulls last for a while, and it seems we've paid our dues like we had historically. 7, the impeachment hearings, they're just another brick in the wall of worry to climb in coming months. This is much more like the Clinton era than the Nixon era. In the Nixon era, the economy was already deteriorating. You had an oil price shock, and you had a smoking gun. In 1998, when the congressional hearings started for impeachment, from that point, the market rallied. The S&P rallied about 56% to the peak from the time the impeachment hearings started. And in this instance, first off, there's a very low probability of impeachment in the House and even lower to no probability in the Senate. And not only is there no smoking gun, there's no smoking cigar in this instance. Okay, so this week, the sentiment survey results came in at 40.72. It's a high level. People are getting bullish. Bearish percent lifted a hair. But, short term in a normal environment, you look at this and say things are getting a little heated. And I understand that arguments. And yeah, we may get a pullback. But we covered last week, go to the Katy Perry article, where these things can stay pinned. And in the case of the bullish percent, they can stay pinned above 50 for a very long time. So go back and review that. This pinning was also confirmed by the CNN Fear and Greed Index at 87. Generally, you don't want to add a lot of risk at this level. So what we've been saying is, trim the ones that have had great moves off the bottom in August or September, or if you've held them longer. And if you're adding to laggard sectors, like we talked about in September, was biotech. They've already rallied about probably today 16.5% off the bottom in the last few weeks. And we also talked about exploration and production in the last few weeks. They're only up, I think, 3.5% from when we put the article out, that sector. So these are laggards that you might still be able to get some bang for your buck as a portion of your exposure. So the other pinned indicator, this is an example from the Katy Perry article last week, is the National Association of Active Investment Managers Index. Yeah, it's at high levels, but can it stay pinned? It can stay pinned for, a year and a half here. It stayed once it broke out. We talked about fourth quarter in 2016 with that earnings growth into 2017. You had pinned. People wanted the equity exposure, and they were right. Same thing here in, coming out of that 2011 period, we got pinned up, from 85 to 100 for, 2 years, a year and a half here. And we may very well be in that situation moving forward. We'll take it day by day. But yes, it's stretched, but it can stay stretched a long time once you have that earnings growth coming back in, which we had flat earnings here, 11% growth here. So far, 10%-ish growth here. Let's see what happens. Got to watch the estimates every single week. We already talked about buying out of favor sectors. You can look at the biotech article from September, the exploration and production article from a few weeks ago. And just to summarize, I'm going to ride till I can't no more. So we laid out the 7 conditions that may imply that the Old Town Road is longer than anticipated and there's a lot of runway. And all we can do is take it week by week, watch the data, and stay on our horse until the data tells us to get off. Hope that helps. Hope you had a great week, and thanks for watching.